When you go to sell your multifamily asset, closing costs and taxes play a big role in what you end up putting in your pocket afterwards. Let's go! Today we're going to go over a sweet spreadsheet, which of course will be available down in a link in the description below, that will go through all of the closing costs and taxes and how they're calculated and what you put in your pocket when it's all said and done. I'm not your attorney or a CPA, so make sure you run all of this by your professionals before you make decisions. Diving right into this, we have a 3-tab spreadsheet. This is what I'll call our after-tax proceeds spreadsheet. Then we have our payment tab, which covers all the amortizations, which feed into the after-tax tab. And then we have the selling expenses tab, which also feeds into the after-tax tab. First, I'm going to show you how the spreadsheet is laid out. Then I'm going to show you how to use it. And then I'm going to show you the created scenario so we can run through our exercise. So we have all of our assumption terms on the left-hand side, which include purchase price and how long you've owned it. We have a depreciation section, the taxing rates, and the financing terms. Over on the right, all the blue numbers are input numbers, which then spit out anything in black, including all of the main numbers below that we're going to go over. In order to show you how the spreadsheet works and how to calculate your after-tax proceeds, we're going to create a scenario, which is we bought a $2 million property in February of 2012, and we're now selling it today, let's assume it's December 20th of 2020, for $3.5 million. Our selling expenses are $181,450. You can see here any cell that has a little red mark on the side of it, here, 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 and I think there's one more down below. Each of those, when you hover over it, has a note. So if you download this spreadsheet off the link I provide, you can see here that this number is coming from the selling expenses tab. If you look at the equation, it is equals selling expenses tab B11. So if we go down to the selling expenses B11, we have the total of $181,450. Again, each of the blue numbers are numbers that you need to input. There's one black number, which is doc stamps, which is typically 0.007 times the sale price. For all of the blue numbers, you'll know more about your transaction and what you need to put in there. For this specific scenario, I assumed 4% commission on a $3.5 million deal, title search fee, title insurance. This is probably around the amount you'd pay for a $3.5 million sale, attorney fees, and of course, other could be whatever. Excel has a cool function where it'll actually calculate the number of days between a sale date and a purchase date. And then, of course, I've just divided it by 30 days in a month, which equals 106 months of ownership, which will come in play when we're calculating your depreciation recapture tax. During your period of ownership, you would have had capital expenditures over that 8-year period. Air conditioning units, roofs, replacement of the parking lot. I made up the number of $143,000 here. The best way, if you'll see the little red mark, is to verify what this number is with your actual CPA, because they're tracking that for you on an annual basis. This number is important in determining what taxes you pay after the sale. Moving on to the depreciation inputs. Commercial real estate is depreciated over a 27.5-year life, but only the building improvements portion of an asset is depreciated. So for instance, even though we had a $2 million purchase price, I'm assuming in this scenario that only about 80% of that equation was buildings. The rest was land. So 80% of $2 million is $1.6 million. Now I have another note here. It says if your CPA can't tell you the amount used, because again, your CPA is tracking this actual number, then you use the same percentage building value that the local assessor has for using for your property. Let me show you. I'm on the property appraiser website in Alachua County, Florida, and they have the assessed values for 2020. The improvement value, which is the buildings, is $916,000. The land value is $135,000, and the just or market value is $1,051,000. So let's do the calculation. From that example, the building values were $916,000. The total market value is $1,051,000. So the building component portion is 87% for depreciation purposes. So on the building we just looked at on the property appraiser website, if that was the same building, we'd put 87% here instead of 80. Now that we know the building value, we know that the annual depreciation, which is the $1.6 million divided by 27.5 years, is roughly $58,000 per year. The total depreciation for the 106-month hold, as you can see here in the equation, is $515,000. Now that you've gotten the benefits of depreciation each year that you've held the asset, when you go to sell the asset, it's now time to pay the piper. And the piper is the Internal Revenue Service. Next up are the tax rates. The depreciation recapture rate is 25%. That's pretty much for everyone. The capital gains tax rate changes depending on your income level. Let me show you. In 2020, here are the single filers. You paid no capital gains taxes long term if it's under $40,000 a year income. Here's 15%, and if you make over $440,000, you're paying 20%. Married, filed jointly, here's those. But there's another small tax to add on. From the IRS website, you then also have the net investment income tax, which is 3.8% added on to the capital gains tax for certain income levels. Married filing jointly is over $250,000, single is over $200,000. I'm going to use the worst case scenario here as though someone meets all income thresholds, so it would be 23.8%. Now keep in mind, capital gains tax rates and depreciation tax rates could change depending on who the president is or who's in power in the House and Senate, so always pay attention to that and always check with your CPA. Keep in mind that the capital gains tax rates that we're talking about in this scenario are long-term capital gains, which means that you've held the real estate for 1 year or longer. If you've held real estate for less than 1 year, different tax rates apply. And the last part of our scenario assumes that when we bought the property for $2 million, we put a 75% loan to value on the property at a 4% interest rate and a 30-year amortization. So the first thing to figure out is the amount of money you're going to put in your pocket from the closing, but before you pay taxes, which is the before tax cash flow from reversion. So you have a $3.5 million sale price, the $181,000 in closing costs up here. So now you got $3.3 million minus your ending loan balance equals $2.1 million. Now, where does the ending loan balance come from? You will notice two things here. That's a blue input number, which means you need to do something. And number two, I have a note here. The note says choose the payment tab month that is equal to B9. So that means we need to go up to B9. That's the 106-month hold period. And we're going to go into the payment tab. So on the payment tab is of course feeding from the after tax tab. So it's got the 30-year amortization at 4% and $1.5 million loan. Here's our full principal and interest payments, interest portion, principal portion, and ending balance portion after each year. Now we held this 106 months. So we need to go to the 106th payment, which is right up here, and go over to the ending balance, and now we have the $1,225,000. So we made 106 payments of $7,100 a month and went from $1.5 million mortgage to $1,225,000. Now it's time to start paying taxes. First, we're going to pay capital gains tax. In order to determine capital gains tax, one of the things we have to figure out is the adjusted basis or net book value. So we're going to take our $2 million original purchase price plus the capital expenditures that we spent during the hold minus our accumulated depreciation over that period, and that gives us our $1.6 million adjusted basis. Next, we're going to take our net sale proceeds, which is from right up above. That's your sale price minus your commission and closing costs. Then we're going to subtract out your adjusted basis that we just figured out, and that's going to be your total taxable gain. Now, of the $1.7 million, one portion of that is going to be at the capital gains tax rate, and one portion is going to be at the depreciation recapture rate. In order to do the capital gains portion, we're going to subtract out the accumulated depreciation, so the $1,175,000 is what you're actually going to pay the capital gains tax rate on. This is where I show you the not so fun part. You're going to see the total amount of taxes from capital gains and depreciation and everything summed up. Your capital gain liability, if you can see the equation, is B45, which is your capital gain, times, you can see here, B19, which is your capital gains tax rate. But now you have to pay taxes and all that depreciation you got to write off every year. Here's the equation for that. B44, which is the $515,000 in depreciation, times B20, which is the depreciation to capture tax rate. Now to sum it all up, we're going to take your before tax cash flow from reversion, which is what you walked away with at closing before paying taxes. Then you paid your taxes and you put $1.7 million in your pocket. That's actually a pretty darn good investment. Think about it. You bought the property 9 years ago for $2 million. You got a 75% loan, which means you put down $500,000. And after that 9-year period, you sold it, paid all your expenses, all your taxes, and walked away with $1.7 million, which is over triple what you put into it. Of course, it would have been lovely to find a 1031 exchange that you can roll all of those taxes into the next property and defer it into the future, but those are sometimes hard to find in the identification period. As I mentioned earlier, this cool spreadsheet is down in the link below in the description. Please subscribe to the channel if you're getting good value out of it, and give me a comment if you would. I'll see you on the next one.